Thank you, Michael and Brian, for a great introduction to Puerto Rico. And my part of the presentation might be the most complicated one. So I always try to make it simple. I'm not going to cover every single detail because it's a lot. But I just want you to get a flavor of what it's the OC program. We call it program. It's really not a program, but it's incentives and how that applies in Puerto Rico. Okay, so there are a lot of slides here. I'm not going to go through all of them because of time constraints, but the presentation is going to be available for anyone that is interested in getting it. And of course, afterwards, you want to connect and send me an email or whatever. We can talk further about your plans and whatever. Please bear in mind each case it's different, so they're not one size fits all answers or solutions. Okay, so as a good CPA, I'm not an attorney. We do have attorneys in our team, but we are a CPA firm. So we in Puerto Rico, CPA firms cannot provide legal services. But if you're in need of some legal services that we cannot do for you, we certainly have bufetes and law firms that we work every day with. So we can refer you if you don't have your own. Okay. So, a disclaimer, I wasn't here. I didn't say anything here. So, that's important. I always like to share our firm's values. These are our global firm values. I work with Kevane Thornton. That's the Puerto Rico member firm of Thornton International. I'm a tax partner. I used to be the tax department head until last year for 19 years. I was also IBC director until last year. And you say, what's she doing? I'm paving the path for, retirement soon. So I'm still a full tax partner and do consulting, consulting work. Our global values clear. It's not misspelled. It's on purpose. We have 2 R's. Because it's collaboration, excellence, leadership, agility, respect, and responsibility. We apply these values every day with our clients, with our friends, and that's why we're here. We are collaborating, we are responsible, and respectful of your intentions to come to Puerto Rico. So that's why we are here today. What is it that I'm going to try to talk about? Some background. And in that background, I'm going to cover some of the OC basics. How you structure one of these things. And you're going to have a panel later of people that have done it already, and they're going to share with you their experiences. One thing I always like to get across, and the OC legislation and regulations are very, very complicated. Very complicated, very detailed. Everything has a definition. So if you're interested in getting into the zone, don't get in the zone alone. Okay? You need experts. And I hate to be called an expert because I think I'm always learning. I'm always researching and studying. An expert for me is something, someone up there. But you need people that do this. They have studied. You need local CPAs, local firms, because Puerto Rico, even though we're part of the U.S., we're a possession of the U.S., we are foreign for U.S. tax purposes. So that makes things different from going to New York or going to Kansas. If you go to Puerto Rico, you're going to a foreign country. We're still U.S. citizens. You don't need a passport to come here. But business-wise, tax-wise, can make a big difference. So you need both U.S. Tax Council and Puerto Rico Council. If you're planning, not really on investing, but planning on moving to Puerto Rico or moving your businesses to Puerto Rico, you need U.S. Tax Council. Very, very important. Okay? Then I'm going to talk about the OC program in Puerto Rico, the benefits that we have in Puerto Rico. Something that Jose mentioned is that OC in Puerto Rico is not equal to uh, priority projects. Something that we're going to talk about. OC in Puerto Rico, you can invest in businesses that are doing other stuff, not just real estate. And we're going to try to talk a little bit about Act 60 and the different type of exemptions and businesses that can benefit from Act 60 that can obtain and can receive OC investment. Okay, so it's not just limited to the priority projects. And then some about the compliance. Okay, I just want to show, we spoke about this before. This is the Puerto Rico map, and as I said, and Michael said, unless you're planning to build something in the sea, in Puerto Rico, you'll most probably end up in an OC, okay? Some basic terms, and these are, very defined terms, but very important terms. Qualified Opportunity Zone, Qualified Opportunity Fund, Qualified Opportunity Zone Property, Qualified Opportunity Zone Business, and Qualified Opportunity Zone Business Property. Okay? The benefits that are provided, through these incentives, and bear in mind, these incentives are included in the U.S. Internal Revenue Code. It's a federal law and its regulations. What happens was that it was extensive. It was made extensive to the territories, and that's where Puerto Rico got into this dance. And as Michael mentioned, every state was limited to designate only or up to 25% of the low-income census tracts based on the 220 census. But because of the situation that Puerto Rico was in after the hurricanes and the financial crisis, there is an exception in the law that allowed Puerto Rico governor to designate 100% of the low-income census tracts, and that's how we end up with 95 to 98% opportunity zone. And what are the benefits? Most of you maybe know this. So just to review, the government says, listen, investors, you have a lot of unrealized capital gains, lying over there. You don't sell because many reasons. One of that is you don't want to pay taxes on the capital gain. This is my proposal. I have these sectors, these zones that need economic development, and nobody likes to invest in them because they're ugly. So I propose you something. I propose you to realize those gains, invest them as I tell you to invest, because of course I'm going to give you some benefits. I want to have some control on how you invest, but I'll give you in exchange 3 benefits. This is to the investors. One important thing, and the question we always get, is what is the benefit for the business in the OC? The benefit for the business is the availability of another capital source. The real tax benefits are for the investors who realized a capital gain and invest that capital gain within 180 days of the realization in a fund. They cannot invest directly in the business. The investment has to be done through a fund, a qualified opportunity fund, which then has from 6 to 12 months, depending on the timing, to invest or to do itself the qualified opportunity business. Okay? So it cannot be a direct investment into a business. It has to be through a fund. Okay? And the first benefit you get, if you do it like this, is that you get deferral of the recognition of that gain until December 31st, 2026, unless you get what is called an inclusion event before. Like, for example, you sell. your investment in the fund. Then you realize the gain before. But if you wait until December 31st, 2026, that's the first benefit. So in this example, there was a gain realized in 2019. It was invested within the 180 days. So if that gain or the investment is kept until 2029, 10 years, on 2026, it's the statutory recognition of the gain. So the person or the investor will have from 2019 to 2026, that's 7 years of deferral of that gain. But important, it's going to be taxed at the capital gain tax rate on 2026, not the capital gain rate of 2019. Okay, so that's a risk there that you have to, ponder. So if you kept it, that's the first benefit. The second benefit was, if you keep your investment at least for 5 years, in this case, it was 2019 plus 5, that's 2024. Instead of paying tax on 100% of your gain, you paid on 90% of the gain. So that's the second benefit. And if you kept it for at least 7 years, you got an additional 5% step up. So you would pay only on 85%. But the best part, and I say the best part, because these two are already gone. You don't have a chance to do that, to get the step up. Because there is no way that before 2026, you're going to get 5 or 10 years. So, but the best part is, if you keep the investment for at least 10 years or more, the regulations extended that higher limit until 2047. The accretion in value of your investment, what I call the second gain, how much your investment increased. If you sell after 10 years or between the 10 years and 2047, you pay 0 tax on that one. Okay? So those are the benefits that the regulation, the law provides. There are a lot of requirements that need to be met. Again, the government is giving you a benefit, a huge benefit, so they want to be sure that it's done, according to whatever they think was best. Okay? There are a lot of criticisms about OC. People are, and the government are asking for transparency and for impact reporting. We foresee a lot of that is coming. Requirements on reporting as something that Michael requested from you. What is it that you're doing? Where? What's the results? People want to know that. Why? Because there are tax dollars involved here. Okay? So those are the basics of OC. Mm-hmm. Mm-hmm. The fund has to reinvest. The fund has a grace period depending on how it happened, maybe 12 months to reinvest what they received. And they need to, because the fund, as we're going to see, has a very tight requirement. To be a qualified opportunity fund, at least 90% of its assets have to be invested in qualified opportunities on property. So if they get liquidated or they sell for whatever reason, that money they need to reinvest in another business. Because if they don't keep the 90%, they get penalized for not keeping the investments. And they can jeopardize the deferral of the investors, okay? Yeah. if the gain is realized, that's a good point. If the gain is realized, and depending on how the entity, if it's a partnership or a corporation, the entity might have to pay capital gain rates, but you can defer it because you can still reinvest, the gain in another project. So the gain is realized, but you can elect to defer. Okay.
10-year clock, does that count on the fund or the business?
The 10-year counts on the investor investment.
Okay, so if you could do an investment a year before the final, before the
See?
year, this
Mhm.
fund, it's still,
Yeah. Because it's the investor. Remember, it's the investor that gets the benefits. Okay? Who's asking? Well, that's a good question. The only way I can find out is and I do it, between time and time. I go to the Department of State site and look for entities with the qualified opportunity fund in their names, because that's one of the requirements. The entity has to be named QOF or something like that. So I look in the Department of State for those, and there are not that many, probably 25 to 30 that have been created. That doesn't mean they're operating. I can talk about what I have. I have clients, and I would say I have a group that have 3 that are open, open funds, and maybe 4 or 5 that are closed funds. Those are the ones that we have in our clients that are already doing stuff. Okay. But again, as Michael said, data in Puerto Rico is. No, closed that they're not open to investors. They're like, family, private funds. Mm-hmm.
well, just to be clear, you could have a qualified opportunity fund in the 50 states that invests in qualified opportunities on business here, and there would be no visibility to
Right.
that.
Yeah.
Not the same requirement for the name of the states.
Yeah, that's a good point. I can take a look at the Department of State for those that have been registered here. Okay, but if you have a fund in New York that is investing in property in Puerto Rico, it might not have to be registered at all. Huh?
You don't have my investment.
No. Yeah. So again, that type of data, I guess once the requirements for transparency and impact reporting comes, we might have more information on that. Okay? No! Come on. Okay. So, all this is defined in the regulations, but I want to make something clear, and it's tied to your comment of someone from a fund from the States investing in Puerto Rico. One of the basic requirements, and sometimes we forget the basics. I always tell my people, let's go back to basics. Okay? When we get questions that blow our minds, we just go back to basics. By definition, an opportunity fund or an opportunity zone business has to be a domestic entity. And domestic for U.S. purposes means organized in the U.S. So entities organized in Puerto Rico are not domestic for U.S. purposes. So just like that, without any more explanations or regulations, businesses in Puerto Rico would not qualify for the investment of funds. And someone realized that, because why you include territories as possibilities of investment, and then the business there do not qualify. So in the regulations, there is an exception. When you go to the regulations, and I have the site here somewhere. There. Regulation 1.1400C2D-1A12B.
That's why you hire Maria.
It says that for these purposes and only these purposes, entities organized in Puerto Rico as a business would qualify to receive investment, but only if they operate in Puerto Rico. Okay? And a fund can qualify, if a Puerto Rico fund can qualify as a QOF only if it's invest in businesses in Puerto Rico. So what this means is that if you have a New York QOF, a New York QOF can come and invest in a business here as long as that business was created in Puerto Rico and only has Puerto Rico property. Okay? But a Puerto Rico fund cannot go to New York and invest in a business in New York. Okay? That has to be clear. And as a matter of fact, there was a question last week on the platform. Okay, I want to talk about Puerto Rico.
So,
Okay.
we have like 5 more minutes before lunch. Are you guys enjoying this? You want to like let Maria do her thing and then we'll go to lunch after? Okay. So you have more than
Okay, thank you. It's very, I'm going like, it's hard to compete with lunch, you know, and it's harder to compete with the bar. So, okay. Thank you, Corey. So, we know those are the basics of OC. You know, I think I hope I cover, you know, the basics. And again, it's very complicated. You saw the regulations. There are a lot of letters. There's like I don't know how many pages of regulations. But why Puerto Rico? Okay, we know Puerto Rico is part of the OC tracks, and why we care about talking about Puerto Rico. And I have an analogy that I think now is almost worldwide famous. It's the cupcake analogy. Some of you have already heard my cupcake analysis. When you have a business, you know, and you have a business proposition to invest, you have to analyze the proposition, the proposal, and determine whether you want to invest there, and you would invest if it's a good investment. It doesn't matter what tax benefits you will get if you get the return you want, right? So that's the cupcake. The business has to be a good business, right? And that's my cupcake. Can be vanilla, chocolate, whatever. Then you put frosting. And how you call it? There's another term for the frosting. We call it frosting here, icing. You put frosting on that cupcake to make it more attractive. Here in Puerto Rico, our frosting or icing are tax incentives, okay, that are unique with no comparison anywhere else. But then we have a cherry on the top of that cupcake. And what's that cherry for us? The OC benefits. Okay? So that's my analogy to Puerto Rico. It's a cupcake where you have a good business, a sensible business, you want to invest on it. We throw in some incentives, and on top of that, it also qualifies for opportunity zone investment. Okay? Remember my cupcake. It's almost famous now. I have to patent it. Okay. So what Puerto Rico did says, woof, out of the 8,700 zones that were designated nationwide, more than 10% are in Puerto Rico. 870-something are in Puerto Rico. So we have a big chunk of the zones. But we need to make this cupcake very more attractive than anywhere else for people in the States to want to invest, not necessarily move to Puerto Rico, but invest in our businesses. So we already have had a very strong incentive program. And now it's Act 60. Before that, there were a lot of different laws. Act 60 is a compendium of all the tax incentives that a business can have in Puerto Rico depending on the type of business. And I have here somewhere a list. Oops. These are the different incentives included in Act 60. And we talk about what used to be Act 22, which are now individuals. We talk about export, which used to be Act 20. But we have a lot more. We have financial and insurance services. We have tourism. We have manufacturing. We have energy. We have infrastructure. You're typing too fast. It's going to be available, okay? It's going like... agriculture, creative industries, film, entrepreneurship. And of course, there is a new one, opportunity zones, which are the priority projects. Why a new one? Because in Puerto Rico, all these exemptions did not cover real estate development unless it was low-income housing. So, refurbishing of buildings or acquisition of a vacant building to create apartments or whatever was not covered by any of this. So they say, in the States, real estate development is number one in OC. So we need to attract this investment to Puerto Rico. And that's when the priority projects incentives were created. Okay? But what I want you to be clear is that for OC investment, it does not have to be a priority project. A fund can invest in any of this type of business or in a business that has no incentives at all, like an entrepreneur.
What is priority project?
So it's in here, so I'm not going to go and look for it, but the priority project legislation was intentional for real estate development. And basically right now, there are 4 different types of project that would qualify as a priority project. And these are construction, development, improvement, whatever, of commercial space for rental or sale, housing for rental or sale, or industrial for rental or sale. So it's driven to real estate development. What's the benefits? The benefits under those priority projects are different from the rest. Okay, I have a table. Let me see. Okay. For almost all the other incentives, not including priority projects, you usually get a 4% tax rate on income. You get 100% exemption on distributions or dividends. You get 50% exemption on the patente and other municipal taxes, 75% on real and personal property. Some of them give you credits, like the tourism projects, where you can get a credit depending of 30 or 40% of the investment. But the priority projects, and 6. Oh, I'm sorry. This is the priority projects. The priority projects get 18.5%, not the 4, 18.5% exemption on, fixed tax rate, no tax on distributions, 25% exemption on municipal and real estate taxes, but the municipality can give you more, up to 75%. But they have to give it to all the business equal, that are the same business as yours in the municipality. So it's not something that you can negotiate. But what is attractive also, is that you get a guaranteed 5% tax credit for the cash invested in the fund. Because one of the requirements for a priority project is that one of the investors or the shareholders has to be a fund. And that's how they tied it with the opportunity zones in the state. So if you put the money on the fund, you get a guaranteed 5% credit of your investment. And that credit can go up to 25%, depending on different criteria that have been developed. And they will give you 5% for each criteria. So if your project meets all 4, you get 25%. This is applied for, along with the application for exemption, and it's reviewed by the DDEC to determine how much of the credit you get. Okay? Yeah, Puerto Rico credit. And if you have no use for a credit, you can sell it. Okay? So you live in the States and you don't have Puerto Rico tax. And you have this credit. There is an open market in Puerto Rico, legal market, where you can sell the credit once. And it's tax-free for you. It's usually sold at a discount, of course, because you want to attract people. The discount depends. You can see credits, going for 92% or 95%, depending on the time of the year you're selling. And you can cash, your investment. We have done some research, and we understand that sale of the credit is not an inclusion event. But again, that's our preliminary research on that. So we talk about this compliance. It's there. You need to file your forms. You need to file your elections. The fund has to self-certify. You're aware of that, but it's here in the presentation. There are requirements for the fund, for the investor, and for the business. Okay? And we didn't get into this, but a qualified opportunity zone business, the one that received the investments from the fund, has very strict requirements by the regulations and the law to be classified as a qualified opportunity zone business. Okay? They have to be an active trader business. So rental, we need to be very careful. It cannot be triple net type of leases. They have to be active businesses. You have to be managing, having employees there, dealing with the insurance, with everything. Triple net leases do not qualify because they're usually very passive. Okay? So one of the requirements is active trader business. 70% of the property has to be qualified opportunities on business property, which is defined. And usually it's property that had been acquired after December 31st, 2017, the date of enactment of the law, and has to comply with other requirements. Has to be 50% of the income has to be generated in an opportunity zone, but here in Puerto Rico, we don't see how we can fail that. And it cannot be a sim business.
And that can be in a different zone, since it's tracked.
Yeah, it's not in one zone, it's in a zone, okay? So the business has to do some compliance work, also. And very important, there is a requirement that no more than 5% of the assets of the business can be certain financial assets. What this does is the business has to invest the money in the business, in the property. They cannot have subsidiaries, because that would be a non-allowed financial asset, stocks or membership interest or whatever. Cash could be a non-allowed, but there is a safe harbor, which is called the working capital safe harbor rule. And this is very important for those businesses that are developing, or doing the construction or doing the improvement. We always recommend to go through the working capital safe harbor rules because that protects you of failing the 5% test, and in some cases of failing the 70% test. So that's another conversation. But very important, compliance. Compliance is key in OZ. Okay, and we have compliance groups in the platform, and we have done several webinars, on compliance.